How to generate more passive income for your portfolio today using covered calls, a 5-step guide. What is a covered call? A covered call is an options trading strategy that can significantly boost your portfolio's passive income. It involves owning a stock and then selling a call option at the same time on the same stock. Here's the breakdown. When you sell a call option, you're giving the buyer the right but not the obligation to purchase your stock at a specific price, known as the strike price, before a specified date. In return, you receive an options premium, which is essentially immediate income. This strategy is best used when you own a stock that you believe will not experience significant price increases in the short term. The beauty of a covered call is that it allows you to generate income from your stock holdings beyond any dividends they might pay. However, there's a trade-off. If the stock's price soars above the strike price, you might have to sell it at the strike price, potentially missing out on higher profits. But if the stock price stays below the strike price, you keep the stock and the premium, which is a win-win. Covered calls are considered a relatively conservative strategy as they use stocks you already own. It's a way to capitalize on your existing portfolio by generating additional income while also providing a potential buffer against minor stock price declines. However, it's crucial to understand that this strategy does involve some risk, particularly if the stock price falls significantly or if it goes up a lot. Can I see an example of a covered call? Suppose you own 100 shares of company ABC, which is currently trading at $50 per share. You're looking to generate additional income from these shares while still holding onto them for potential long-term gains. To execute a covered call, you decide to sell one call option representing your 100 shares with a strike price of $55, expiring in 1 month. For selling this option, you receive a premium of $2 per share or $200 in total income. 100 shares times $2 per share. By selling the call option, you're granting the buyer the right to purchase your shares at $55 each, but only if ABC's stock price exceeds $55 by the option's expiration date. If the stock price stays below $55, the option will likely expire worthless, and you'll keep the $200 premium as a profit, in addition to retaining your shares. However, if ABC's stock price rises above $55, your shares will likely get called away. In this case, you will sell your shares at $55, realizing a gain of $5 per share from the stock, $55 strike price minus $50 original share price, plus the $2 in premium from selling the option, totaling a $7 per share gain. The strategy is beneficial as it allows you to earn income from the premium while potentially benefiting from a moderate increase in the stock's price or a moderate drop. However, it's important to remember that if the stock price surges well above $55, you might miss out on higher profits since you're obligated to sell at the strike price. 5-step guide to implementing covered calls. 1. How can I choose the right stock? Start with stocks in your portfolio that are stable and have a history of paying dividends. Look for stocks you expect to be relatively flat or only slightly bullish in the short term. 2. How can you select the strike price? Choose a strike price that is higher than the current stock price, but within a range you believe the stock will not exceed during the option's lifetime. 3. How do you determine the expiration date? Opt for an expiration date that aligns with your income goals and market outlook. A common approach is to select options that expire within 1 to 3 months to maximize theta decay or time value decay, which is essentially a melting ice cube when selling options. 4. Sell the call option. Once you've chosen the stock, strike price, and expiration date, sell that call option. You'll receive the premium up front, which is yours to keep regardless of whether the option is exercised. 5. How should you manage your position? Keep an eye on the stock's price and the market conditions. If the stock's price is nearing the strike price at the expiration date approaches, you may need to decide whether to buy back the option, let the stock get called away, or roll the option out in time and up in strike price. Enjoying this video? Please like it. Bonus tactic: rolling covered calls up and out. What is it and how to do it? Rolling a covered call up and out is a strategic maneuver in options trading that can be particularly beneficial when the underlying stock's price is rising faster than you anticipated. This technique involves buying back the call option you initially sold and simultaneously selling another call option with a higher strike price and a later expiration date and time. The primary benefits of this strategy are the potential for additional capital gains on the underlying stock and the collection of more premium income, while still maintaining a level of protection against the potential downturn in the stock's price. For instance, let's say you own shares of ABC and you sold a covered call with a strike price of $100 set to expire in 1 month. As the expiration date nears, ABC's stock price unexpectedly rises to $105. To capitalize on this upward trend and avoid having your shares called away at $100, you decide to roll the call up and out. You buy back the $100 call option and simultaneously sell a new call option with a strike price of $110, expiring in 3 months' time out into the future. By doing this, you receive additional premium income from selling the new call, and you give your ABC shares more room to grow in value. If the stock price continues to rise, you stand to gain more from the stock appreciation up to the new $110 strike price. Additionally, the extended expiration date provides more time for the stock to potentially increase in value. However, it's important to note that while rolling up and out can maximize potential gains, it also extends your commitment to the covered call strategy and the associated risks. This approach requires careful consideration of market trends, stock performance, and your overall investment goals. Rolling a covered call up and out can be a smart way to adapt to changing market conditions and optimize the returns on your stock holdings. When to use covered calls. Covered calls are particularly effective in high volatility environments, like when the VIX or the volatility index or implied volatility is elevated. In such scenarios, options premiums tend to be higher and more juicy, offering more income potential for the seller. However, this also means that there's a greater chance of the stock price reaching the strike price. Therefore, it's crucial to be selective with the stocks you choose and conservative with your strike prices. Remember, the goal is to generate income while minimizing the risk of losing your stock at a price lower than its potential market value. This strategy is best suited for investors who are looking for additional income from their stock holdings and are comfortable with the complexities of options trading. It's a methodological approach to generating income, not a speculative play, and requires careful consideration of market conditions and individual investment goals. Covered calls can be a powerful tool for generating additional income from your existing stock portfolio. By understanding the mechanics of the strategy and carefully selecting your positions, you can effectively harness the power of your investments to work in your favor. However, it's essential to approach the strategy with knowledge, caution, and an understanding of the risks involved, especially in volatile market conditions. With the right approach, covered calls can be a valuable addition to your investment toolkit, helping you generate more passive income today. Remember, this is not financial advice. Withdrawal Investing Insights, signing off.